The Mag 7 has got a ton of attention from the market, and for good reason. These are some of the most dominant companies in the world today, but they're not all great buys for different reasons. So I want to go through all 70 of these stocks and end with the one company that I would buy and that I have been buying in 2024 and could potentially add more in 2025 because I think the price is just too good to pass up. So I'm going to basically order these from worst to first if you're interested. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the first company. This is a company I actually have a short position via puts. That is Tesla. Tesla, I think, extremely overvalued. If you look at how most auto companies, and this is an auto company, trade today, they trade at a price to earnings multiple of about 6. They also are typically growing revenue. Tesla is not growing revenue right now, at least in the auto business. And early in 2025, it's likely that they're going to have a really terrible quarter in the first quarter. Analysts are tripping over themselves to update their delivery estimates. Seems like those are going to be down pretty significantly, not only in Europe and China, but also here in the US as well. So we'll see early in April what those delivery numbers look like, but probably going to be significantly lower in both revenue, net income, free cash flow, everything for Tesla. I think this is a company that should absolutely not be trading for 9 times sales or 122 times earnings. It should be trading for potentially a tenth of that or less. A typical automaker today is going to be trading for about 0.3 times sales and about 6 times earnings. So a lot of downside potential for Tesla, but that's why I have the position that I do. We'll just scratch them off from the beginning. The second one is Apple. Apple has really lost its magic. I did a video on that recently. So if you want to check that out, you can see my more detailed thoughts, but price to earnings multiple for Apple, 34.8. 3-year growth rate, 1.5%. So growing less than GDP, less than inflation. These are terrible numbers. And the bottom line for Apple is just that they don't have any new compelling products. This is fundamentally a hardware company that attaches software, and the combination is what makes it more valuable. But if they're not selling more hardware, then they don't have a very good business. And if you think about all their products, they're relatively old. The durable life of each of these products is extending. So that's making that refresh cycle for things like AirPods and iPhones a lot shorter. That makes this a tougher business. That's why this growth rate is so anemic. And I think without the services business, which is really just a tax on everything that we're using our Apple devices for and on developers, I think this would be a much, much less valuable stock. So going to scratch them off as well. The next one may be a bit of a surprise, but that's Microsoft. Microsoft has similar high PE multiple, 31.5 on a forward basis, 28.3. Really solid company. And I think Satya Nadella has done a really good job. They've gotten a lot of attention in artificial intelligence, but I don't think this is actually an AI leader. Their Copilot products have not all been all that successful. Their partnership with OpenAI, I think, is falling apart before our eyes. OpenAI still has ties to Microsoft, but Microsoft did not participate in their latest round. It seems like they're really emphasizing other models and the fact that models are commodities. That's tough for a business that you put tens of billions of dollars into. So I think Microsoft potentially well positioned in the cloud, but is that worth 32 times earnings today? I just think this is too much to pay for a company that doesn't have a lot of innovative products coming out right now. And potentially other companies are better values and have better growth in the cloud. I'll get to one of those in just a second. The stock that sits in the middle is Amazon. Amazon price to earnings multiple 35.5, PE on a forward basis is about 31. Again, you get a good cloud business, but you also get the retail business. And fundamentally, I think for everything that Amazon has done right, they just have not proven to be particularly profitable in retail. Yes, they have a huge business, a ton of revenue coming in the door, but they're not particularly profitable. And I think, again, a little bit like we see with Apple, things like their advertising growth is just a tax on the people who are actually providing products, their third-party suppliers in retail. And if you even just look at your experience on Amazon.com or on the app, you search for something and you just get a whole bunch of ads. That's not a great user experience for a company that's supposed to be the most consumer-centric company in the world. That was what they were built to be. I think that experience has really deteriorated. Now you're leaning on the cloud. There's potentially, again, other companies that are better positioned in the cloud and to grow in the cloud than Amazon is. The next one, like this company, have never owned it, but Nvidia Still pretty expensive. I know that on a forward basis, price to earnings multiple is about 26. So that seems pretty attractive, but there's a lot of potential headwinds. We're seeing revenue growth slow. That's not all that surprising given the astronomical growth rate that they had a couple of years ago, but their margins are also starting to come down. So if you have slowing revenue growth and margin compression, we could see multiple compression over the next few years. So that's some headwinds that I think add a lot of uncertainty. So just not one that's at a no-brainer price at this point. Next up is Meta Platforms. Meta, I think, really solid company, decent valuation, 25, 23.5 on a forward basis for a price to earnings multiple, generating solid free cash flow. But again, some of those decisions like spending so much on the metaverse and AR glasses and stuff like that, and the fact that you're basically just buying Mark Zuckerberg. Mark Zuckerberg controls this company. That just makes me a little bit hesitant. Again, if it was a better price, this is probably true for all these companies. If this was a better price, I would jump all over it. But that leaves us with the one company that I think is a compelling buy in the Mag 7 today. That's Alphabet.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
Alphabet has a price to earnings multiple of 20.4. So the company that is generating tons of free cash flow, billions of users on multiple products all around the world, trades for arguably the best multiple out of any of these companies. On a forward basis, the price to earnings multiple is just 18.3. So there is a lot to like about Alphabet today. And let's just go through some of their businesses, because I think this is where things get really interesting, is when you actually start to take a step back and look at how well positioned they are. You, of course, have Google Search. This is kind of the core business. A lot of people thought that this was going to be disrupted by artificial intelligence. I would actually say the opposite, that the fact that they've been able to insert a lot of AI tools into the traditional search product. If you're a Chrome user, for example, and by the way, Alphabet makes Chrome, you have a lot of those tools already integrated into your experience, and you're not going to move from the default search engine more likely than not. Same thing with their partnership with Apple. That's going to be what you're searching right there in the Safari browser, unless Apple takes that away. But again, Alphabet and Google is paying a ton of money for the right to be there. So really good position in search. I know that a lot of investors maybe don't love that business, but I think this is just going to be a cash cow for the foreseeable future. Typically, new technologies don't destroy the old thing. They just build on top of them. I think we're going to see the same thing with search. YouTube. This is just ad revenue. They don't break out premium revenue as well, but you add those two things together, this is over a $50 billion business on an annual basis. Bigger than Netflix, bigger than Disney streaming services. This is the biggest streaming company in the world. A lot of people don't realize that, but phenomenal position for them to be in with YouTube. Subscription platform and others. So this is everything from G Suite to their hardware devices. So Pixel phones, Android is going to be in there in the Play Store. Again, phenomenal position because they are a platform company. You're building your business on Gmail, for example, or you're building your life on the Android platform and everything that you have with Google services. These are the kinds of things that they're going to be able to layer on their AI solutions as well. Speaking of AI, the Google Cloud is a phenomenal growth business for Alphabet today. And it's also now profitable. Over the past year, $6.1 billion worth of operating income, and those margins are improving quarter after quarter. I think if you paid attention to artificial intelligence just over the past couple of months, you would see that Google and DeepMind, who has actually taken the lead on their AI products now, have really taken some huge steps forward. They made some really phenomenal models. They released Gemini 2.5 recently. That seems like it's leading in a lot of the typical benchmarks in artificial intelligence. Their products are getting better. It's kind of behind the 8 ball if you look at something like ChatGPT. But this is, again, a company that has the money to keep investing in both infrastructure and in new model building. Not a lot of companies have that economic moat. OpenAI, if they want to build a new model that costs, let's say, $10 billion to train, they're going to have to go out and raise money to do that because they're losing money on their core business. Alphabet, not in the same situation. They're going to be able to continue to invest in this. And their founders have said that this is an existential risk. Artificial intelligence is an existential risk. So they're going to be spending about $75 billion this year to maintain that lead. That's just the CapEx. On top of that, you have all the operating expenses to build out these models. So I think Alphabet, phenomenally positioned for the future of artificial intelligence. You have billions of Android devices out there. You have people using YouTube, search, so many touch points. And all of those advantages just aren't really valued by the market. Trading for just over half the multiple of Apple, who is a no growth company. Alphabet, not a no growth company. Revenue growth 10.8% on a compound annual basis over the last 3 years. Over the last 10 years, 18.2%. And that growth rate is ticking higher, especially as search comes out of some weak points because of ATT, Apple's ATT a couple of years ago. So Alphabet, I think, phenomenally positioned, not only really good strategic position, we're starting to see their financials are really good. They got a ton of cash flow. They're able to buy back stock, pay a dividend, and also the valuation is right. That's really the key with a lot of these companies. You don't want to pay too much for companies that are already the biggest companies in the world. But this one, you're getting it for about 18 times forward earnings. That's a great price to be paying for Alphabet. So that's why it is my top Mag 7 stock today. Let me know what you think. What is your order? I'd love to hear what everybody's order for the top Mag 7 is today. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next.